Imagine up tomorrow checking your phone and seeing the Iraqi dinar trading at 4.21 against the US dollar, while the Vietnamese dong skyrockets to 3.04. Millions of currency holders around the world would instantly become wealthy beyond their wildest dreams. That's the exact rumor racing through investor circles in 2025, sparking endless debates, heated arguments, and a new wave of hope for people who've held onto these currencies for years. But is this really possible, or is it just another round of hype? Today, we're going to break this story down piece by piece, in plain and simple language, so you understand what's fact, what's speculation, and what these rumors could mean for your financial future if you're holding dinar or dong right now. Right now, the Iraqi dinar trades at around 300 dinars for every US dollar. That means one single dinar is worth less than 1 penny. For the dinar to leap all the way to 4.21, we're talking about one of the biggest currency revaluations in modern history. It wouldn't just be a jump, it would be an economic earthquake felt worldwide. For the Vietnamese dong, the current rate is roughly 24,000 dong to a dollar, which makes one dong worth less than half a cent. A sudden jump to 3.04 would mean an even bigger leap, millions of percent higher than what we see today. These numbers sound exciting, but they also raise serious questions about how such massive changes could actually take place in today's global financial system. Supporters of these rumors argue that Iraq's natural resources justify such a bold revaluation. Iraq holds some of the largest oil reserves in the world, over 140 billion barrels of proven crude oil. The theory is simple: if Iraq stabilizes its government and leverages its oil wealth properly, then its currency should reflect that wealth. In the case of Vietnam, believers upon the country's rapid economic growth, strong manufacturing base, and rising importance in global supply chains. Over the last 20 years, Vietnam has been called the factory of the world by many economists, producing everything from electronics to textiles. This economic momentum, they argue, could fuel a stronger dong. But even with these arguments, the numbers being tossed around 4.21 and 3.04 are so dramatic that they deserve closer examination. To understand whether such revaluations are realistic, we need to look at what makes a currency strong in the first place. Currencies don't just gain value because a country has oil or factories. They rise when international investors trust the government, the financial system, and the long-term stability of the economy. For Iraq, this means political stability must be restored in a way that lasts for generations, not just months. It means consistent government policies, a reliable banking system, and a regulatory environment that attracts foreign investment. Without these conditions, oil reserves would not push the DAR to 4.821. For Vietnam, while economic growth is strong, stability and predictability are just as important. Foreign investors want to know their money is safe and that the government won't make sudden policy shifts that create risk. A jump from the current dinar rate to 4.21 would mean an increase of well over 500,000%. For the dong, the proposed 3.24 figure would require an increase of more than 7 million%. These are not just big numbers, they're historic. Nothing in modern currency history compares to this scale of change, except in cases of crisis, redenomination, or complete economic resets. For example, when Germany introduced the Deutsche Mark after World War II, the old mark was exchanged at 10-1. In Turkey, 6 zeros were removed from the lira in 2005, but that was simply redenomination. It didn't magically multiply purchasing power. These real-world cases show us that while currencies can change dramatically, they almost never rise overnight to make investors rich. The Iraqi dinar story often leans heavily on oil wealth. Iraq is the second largest oil exporter in OPEC and continues to supply a massive portion of global energy needs. However, converting oil wealth into currency strength isn't simple. Oil revenue must be managed through transparent systems, reinvested into infrastructure, and used to diversify the economy beyond energy. Without these steps, oil wealth often creates what economists call the resource curse, where a country becomes dependent on one export while the rest of the economy struggles. If Iraq wants the dinar to strengthen in a real and lasting way, It will need to build trust with international markets, enforce financial regulations, and show that it can operate as a stable economic partner. Oil alone isn't enough. Vietnam's case is quite different. Unlike Iraq, Vietnam does not rely on oil exports to fuel its economy. Instead, it has become one of the most important manufacturing centers in Asia. From Samsung smartphones to Nike shoes, global brands rely on Vietnam's factories. This has helped Vietnam achieve steady GDP growth, often between 6% and 7% annually. But while this growth is impressive, it doesn't automatically translate into a massive currency jump. The dong has appreciated slowly over the years, but governments and central banks typically prefer gradual, steady changes to avoid economic shocks. A sudden overnight revaluation to 304 would disrupt Vietnam's trade advantage, making its exports far more expensive on the global market, which could actually hurt its economy instead of helping it. One of the most important things to understand about revaluations is how central banks view them. Stability is the #1 goal for most central banks. They want predictable currency movements that help exporters, importers, and investors plan for the future. Sudden massive jumps or drops in currency value create chaos, disrupt contracts, and scare away international partners. This is why we rarely see revaluations of the scale being discussed today. Even in the case of countries experiencing rapid growth, central banks prefer controlled, gradual appreciation, not explosive changes. This means that while 4.21 and 3.04 might be exciting numbers to imagine, the reality of central banking policy makes them extremely unlikely. Investors who buy into these rumors often point to hidden plans or secret agreements waiting to be revealed, but history shows that currency changes are almost always announced publicly and carefully managed to prevent chaos. For example, when countries redenominate their money, they give citizens and investors months of notice, clear exchange timelines, and detailed instructions. No government simply wakes up one day and multiplies the value of its currency thousands of times without warning. That would destroy trust instantly. So, any claim about secret overnight revaluations should be treated with extreme caution. That doesn't mean the dinar or the dong have no potential. Both Iraq and Vietnam have paths towards stronger currencies. For Iraq, the key lies in political reform, rebuilding infrastructure, and diversifying beyond oil. For Vietnam, the focus is on sustaining growth, attracting more foreign investment, and modernizing its financial system. If these steps are taken, both countries could see their currencies rise gradually over time, but the timeline would likely be measured in decades, not days. Real economic strength builds slowly, and currency values reflect that process step by step. Paragraph 10b should also look at risks. Currencies can lose value as quick as they can gain it. Political turmoil, war, corruption, or sudden economic shocks can send exchange rates downward. Iraq, for instance, has faced decades of instability, and even today in 2025, it still struggles with governance issues. Vietnam, while much more stable, is vulnerable to global trade disruptions. If the world economy slows, demand for Vietnamese exports could shrink, putting pressure on the dong. So, while some investors dream of overnight riches, the reality is that currency investing carries significant risks that need to be considered carefully. Diversification is one of the most important lessons in investing. Putting all your hope and money into one currency, no matter how exciting the rumors, can lead to disappointment. Smart investors spread their money across different assets, including stocks, bonds, real estate, and even some foreign currencies. But they don't rely on just one big bet to change their lives overnight. If you are holding dinar or dong, it should be part of a balanced strategy, not your entire plan. That way, even if the massive revaluations don't happen, your financial future won't collapse. Another key point is to watch out for scams. Whenever rumors about currency revaluations spread, scammers take advantage. They promise guaranteed profits, special insider information, or secret exchange rates. No one can guarantee the future of a currency. If someone tells you they have access to private government plans or that you'll become rich if you buy now, that should raise a red flag. The truth is that currency markets are unpredictable, and anyone promising certainty is either misinformed or trying to mislead you. So, what would it take of the dinar to realistically rise in value? First, Iraq would need long-term political stability. Investors must trust that policies won't change with every election or power struggle. Second, the banking system would need deep reforms, making transactions safe and transparent. Third, Iraq would need to expand beyond oil, creating industries that make the economy resilient to oil price swings. Only when these conditions are in place can the dinar begin to gain ground in a real, sustainable way. For Vietnam, the story is more about continuation than transformation. The country has already proven it can grow at impressive rates. The challenge now is to sustain that growth while moving up the economic ladder. This means not just producing cheap goods, but also investing in technology, education, and innovation. If Vietnam continues to modernize and attract global companies, the dong could strengthen over time. But again, this would likely mean small annual gains, not sudden leaps into multiple dollars per unit. Let's imagine for a moment that the 4.21 and 3.04 revaluations did happen. What would the consequences be? Investors holding dinar and dong would become incredibly wealthy overnight. But the flip side is that both Iraq and Vietnam would face economic chaos. Exports would collapse because their goods would suddenly become too expensive for the world to buy. Inflation could spike as domestic businesses struggle to adjust. International contracts would be thrown into confusion. In short, what sounds like a dream for investors could be a nightmare for the countries themselves. This is why massive overnight revaluations almost never happen in real life. A more realistic scenario is gradual appreciation. For Iraq, perhaps the dinar could rise slowly as the country rebuilds and attracts more investment. For Vietnam, perhaps the dong could strengthen as manufacturing continues to grow and the economy modernizes. These are stories of long-term progress, not overnight miracles. Investors who understand this are better prepared to make smart decisions, while those chasing quick wealth may be setting themselves up for disappointment. In 2025, the world economy is interconnected like never before. Currency values affect trade, investments, and even geopolitics. A sudden, massive revaluation of the dinar or the dong wouldn't just affect Iraq or Vietnam, it would ripple across the entire globe. Banks, corporations, and governments would all be forced to react. This makes it even less likely that any country would risk such a move without years of preparation and global coordination. The global financial system simply isn't built to handle overnight changes of that scale. So, what should you take away from these rumors? First, it's important to stay informed and cautious. The numbers being discussed, 4.21 for Iraqi dinar and 3.04 for the Vietnamese dong, are almost certainly exaggerated. While both countries have economic potential, the path to stronger currencies will be slow, steady, and filled with challenges. Investors should focus on realistic expectations, balanced strategies, and careful research. Currency investing can be part of your plan, but it should never be your only plan. And remember, if something sounds too good to be true, it probably is. Stay smart, stay skeptical, and keep your eyes on the bigger picture.